Hello everyone. Today on the Final Bar, we'll be setting up for success this week. We'll talk about some of the market conditions on Friday. Strength, as my friend Jay Woods reported on from the floor of the New York Stock Exchange. What changed today with one of the most leading stocks, Apple, pulling back big time? Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of technical analysis. The technical toolkit is really driven by investor behavior, and we have tools available to us on a platform like StockCharts to quantify investor behavior, to get inside the heads of all those other investors and really understand the interplay between fear and greed, between supply and demand, between euphoria, which arguably Friday was sort of a perfect example of, and come back to earth sorts of moments, maybe like we're seeing today with small caps leading the way to the downside. Super excited. Jay Woods was able to do the show on Friday, allowed me to go visit some family in Ohio with my family, which was a real fantastic time. Jay did a great job explaining that surge in breadth, and had we done a show and I'd been the host on Friday, we would have hit that same exact area. The improvement in breadth is important. What I would argue from today and further on through the course of this week is the sustainability of that breadth. Was that just one surge in breadth on Friday, or is this something bigger, right? No denying that the major averages are pushing higher. The S&P and the NASDAQ making new swing highs last week. We're going to look at the charts and make our own assessment as to the sustainability of those gains from last week. Let's get to our market recap. I do want to start with a poll question. We always have a poll going on our live stream page at StockCharts.com, also on our social media accounts. And we asked you recently, which of these would you rather own over the next 3 months? And I gave you three choices: consumer discretionary, what I would consider offense; consumer staples, what I would generally consider defense; and cash, pretty much nothing but defense. Overall, 2/3 of you said consumer discretionary, and that's very interesting. What's interesting is we ran this poll over the weekend, so after Friday's nice move, we're getting some renewed optimism. I feel like we answered that or asked that same question about a week ago. I'm wondering how different the results may have been, probably with a little more of a leaning towards consumer staples. Now, what's interesting is some of those names within consumer staples like Coke and Pepsi and PG, we've talked a lot over the last couple weeks about how they had been incredibly strong, testing previous highs, but then failed and sort of pulled back from there, while other areas of the market, particularly the XLY, has been pushing higher. Now, Amazon has been looking strong. Some of the other names in there, Tesla as well. I know Jay talked about that one on Friday. So had I voted, boy, I probably would say consumer staples, given the fact that the seasonal trends are definitely not in favor of consumer discretion here. More likely than not, in an average year, this is more of a defensive part of the calendar. But again, I think you guys are all picking up on the strength in the trend, and I cannot deny your opinion as trend followers. So well done, and I appreciate you voting in our poll. Let's get to the rest of our market recap. Let's start with the major averages. I mentioned underperformance by small cap, and not by a little bit, by a lot. The small cap index was down about 2% today. Let's look at the charts and see what we can uncover. S&P 500 down about 0.2% to 4274, just below there. The NASDAQ composite was up through much of the day, but actually ended up just barely negative. We'll call it 0.1% to the downside, but not by much. And the NASDAQ composite's currently at 13,230. Mid caps down about 1%, small caps down about 2%. So while Friday, I feel like it was a return to some of the cyclical leadership, some of those areas that have been underperforming, like energy and financials and materials, just surged on Friday up 2-3%. Back to normal today with the small cap index and a lot of those same sectors struggling. Small caps, again, have been a chronic underperformer in 2023. That has been arguably the story, and one of the key narratives is the mega cap dominance of these markets. We're seeing more of that. Although, as I mentioned in the intro, one key mega cap name, Apple, having a tough day as they have their developers conference today. Volatility continuing to go lower, and the VIX overall pretty low, and actually down just below 15, up just a slightly today, but but Friday really pushed to the downside. So what's interesting is we are, again, very much in a 2021 kind of environment in terms of the relationship between the equity indexes and volatility. You're seeing the major indexes move, sort of churn their way higher, stepwise motion to the upside, volatility remaining fairly low. Remember, not too long ago, we were talking about whether the VIX would get below 20. It's actually well below 20, even below 15. It's currently down around 14.7. So low volatility, strong stocks, pretty encouraging for bulls, I would say. And we'll talk about high yield spreads in a little bit. Also pretty bullishly positioned at the moment. In terms of the yield curve, we actually have a steepening of the curve just slightly today, with short-term yields coming off a bit, 5-year yields as well, and then the 10 and 30-year points actually going slightly higher, not by much though. So you have a little bit of a return to what's more of a normal yield curve, but let's be clear, still very much inverted, with the short-term point around 5.1% and the long bond currently around 3.9%. So we still have a downward sloping, or what's called an inverted yield curve, usually a very consistent indication of a recessionary period, and usually suggests economic weakness, or the lack of economic growth, maybe is a better way to put that. Dollar not too different from Friday's close, with the UUP down about 0.2%. Commodities actually quite mixed today, and you can see that the DBC, which is a broad commodity ETF, certainly more of an energy focus than other parts of the commodity complex, but down about 0.25%. Gold actually up 0.6%. The GLD is potentially bouncing off of the lower end of a channel. We'll try to get to that chart if we can, but I'm already saying how many charts we're going to get to, and we usually run out of all that time. The rest of the commodity space sort of mixed, a little up, a little down, and not much else to report. In terms of cryptocurrencies, a lot of red. We're getting yet another sort of regulatory headline. I feel like that is the biggest risk to the crypto space, besides general stability and general buy-in, right? People adopting this new technology and these different forms of exchange. I think one of the big risks is regulatory risk, and it shows you the risk very much real today, with Bitcoin down 5.5%. Bitcoin now down to 25,600, just slightly above that. Ether still above 1,800, but not too far above that, and that's down about 4.5%. You can see the rest of the major cryptos that we track down about 5 to 10% today. So overall, when you have that headline risk, or the headline risk, sort of like some big news event that causes something to move, I would describe this more as a regulatory risk, right? The real arguable benefit of cryptocurrencies is that they are unregulated, or very lightly regulated, and I think a lot of regulators are sort of have the opinion that they maybe should not be so lightly regulated, and a news headline like we saw today causing a bit of a plunge in here in the cryptos. We'll look at the chart of Bitcoin in a moment if we can. Finally, at the end of the day, it's actually quite a lot of movement in the sector returns today. Utilities ended up at the top of the list, followed slightly behind by healthcare and consumer discretionary, all up about 0.3 to 0.5%. 7 out of the 11 industry sectors or economic sectors down today, with industrials, energy, and technology all down about 0.6%. Let's look at a chart of the S&P 500, sort of check in on what happened. Again, we didn't have a show on Friday. Jay Woods, again, thank you so much for hosting the show. You did great. He wrote me after and said it's not easy to be talking and bringing up charts, and I would 100% agree with him. That is a routine that gets easier with time, Jay. But overall, I thought his content was spot on, and his delivery was excellent as well. And we talked about that surge in the S&P well above 4,200. We've been talking a lot about 4,200 as a key level of resistance. That's been this thick green line on our chart for quite some time. And the question was always, can we break above there and follow through? We closed above it on Thursday of last week. Friday, we really gapped higher and just pushed to the upside. What's so interesting now, what we talked about is 4,200, important level. If we break that, this last one is this pink shaded area. This is the 4,300 level, which is the August high, actually a little below the August 2022 high. 4310, if I remember right, is a 61.8% retracement of the way back up from the October 22 low to the January 22 high. So you think about that big downtrend in 2022 through October. We then turned back higher. 61.8% of the way up is right in line with those August highs. That's why that's been a really key level in our mind. Some of my guests have really picked up on this as well. I know Mark Newton has been focusing on that level. We've talked about that on his most recent appearance and off the show as well. So we're there, right? And today on an intraday basis, we ticked right up to 4,300, and then magically buyers are exhausted, and we see sellers come in and push the price to close around 42.74. So 43 to 43.25, I would argue, is the level. Boy, this is the last one, because I think if you break through that, I don't know what else I would see up to 4,800, but nothing super important. I would say that certainly says a return to the 2022 highs is very much on the table, and I think looking to see if we break above there. Not quite there yet. Now, what's interesting is some of the measures of strength have already triggered. New Dow theory looks at the S&P 500 and the NASDAQ composite. Really Friday, today not much. I mean, they both pulled back a little bit, but Friday I think really put an exclamation point on the strength of these trends. Now, again, this is basically showing you the strength in the nominal indexes, right? The indexes that are calculated based on market caps, so the biggest stocks that are driving the lion's share of these data series. But there's no denying the fact that the trends are positive. One of the concerns has been the weakness in breadth and the lack of breadth support. And what I will tell you, there are a number of ways, of course, we measure market breadth. We're going to do a mailbag after the break, and we have a question on this particular chart, so I'll save too much discussion about it, except to say that as of Friday, the McClellan Oscillator well above zero. Look at the shaded areas in red when the McClellan Oscillator is generally below zero, and the green shaded areas where it's generally above zero. We're back to an environment similar to the rally phases over the last 12 months. So that gives me more confidence, because this is actually an equal weighted measure of market participation, and it's actually enough strength that it's suggesting that there may be some encouraging sign for stocks. Maybe two charts left before the break. And the next one I wanted to go to was high yield spreads. Well, if you think about it, right, high yield spreads basically are looking at the fixed income market, looking at bond investors and investors that trade in riskier stocks or bonds of riskier companies, that is. This is plotted inversely just to make it line up a little better with the S&P 500. You can see that spreads are narrowing. They're coming in, meaning investors are requiring less of a spread, less of a compensation for owning the debt of risky companies. You see how this line is going up, which means the spreads are coming in, volatility is decreasing. All of that tends to be very much a favorable environment for stocks. So I'm getting very much a risk-on feel from the high yield market, from volatility, and also from price itself as the S&P continues to go higher. Just really briefly before the break, I have to talk about Apple. Apple giving a bearish engulfing pattern today. If you look at the candle chart, you'll see a big higher open, wide range today, closing lower. They have the WWDC conference today. A lot of announcements, a lot of new product lines and products announced that I haven't had time to go through, but I certainly will. But I will tell you from a technical perspective, investors basically saying overbought on Friday. Today, bearish engulfing patterns suggest short-term weakness over the next 1 to 3 bars. Let's take a quick commercial break. We'll be back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller at StockCharts.com. We appreciate you so much joining us every weekday after the close for our show. We're going to crack open the Final Bar mailbag here in a few moments. Before we get there, I want to invite you to send your own questions. We love doing the mailbag. We love hearing from you. All of your questions about technical analysis, about the StockCharts platform, whatever it is, we're here to answer them. Our email is thefinalbar@stockcharts.com. We're on Twitter @FinalBarSCTV. We are on YouTube. Put a comment below the video you're watching on our StockCharts TV YouTube channel. We'll hope to answer your question live on the air on Friday's show. Upcoming schedule, some great macro strategists coming through the shop this week, and we are super excited to talk to Ryan Dietrich of Carson Financial Group. That's coming up tomorrow on the 6th. On Wednesday the 7th, Adam Turnquist of LPL Financial will be joining us on the first time. Adam used to work with Craig Johnson at Piper Sandler up in Minneapolis. Now is the strategist at LPL Financial, does a fantastic job, and we'll get his take. Willie Delwich from High Mount Research will be coming back on the show on Thursday the 8th. Let's continue on with the Final Bar mailbag. Please keep your great questions coming to us. And let's get to question number 1. Dave, the McClellan Oscillator works only with a 1-year time frame. Why not shorter time frames? You had a longer question where you're asking about, we're looking at a 1-year time, which is what I usually show on the channel. What about shorter time frames? Why can't I run it on an intraday, like an hourly chart or something like that? I'm going to show you my same McClellan Oscillator chart. And forget about the colors, of course. This is just looking at the data. You'll notice that I'm looking at a daily chart. I usually look at 1 year of data. That's kind of my standard go-to chart when I'm bringing up a series like this, a breadth indicator, just to show a ratio versus the S&P 500. I think what you're asking about is, what about something different? What about if I do like a 15-minute chart? If I'm more of like a day trader or a swing trader, I want to understand what's happening there. And I get this really creepy error message that says intraday data is unavailable. What you have to remember is something like a McClellan Oscillator is based on raw stock data, and it's a breadth indicator. And the way that breadth indicators like this are usually calculated is you wait till the end of the day. Now, you could calculate it intraday. We actually don't with this one. We calculate it at the end of the day, and so we basically get all of the data together. This is based on the difference between two advanced decline data series, or rather taking two different exponentials of advanced decline data, calculating the spread and plotting that as this McClellan Oscillator, and we adjust it. It's called a ratio adjusted, which makes a more consistent history if you're looking back over time. If you look at our ticker on our platform, if you see a little EOD, that stands for end of day, which means we only calculate it at the end of the day. We get all the official closing data, and then we have a big breadth series that runs. The data team is crunching all this data and updating the new data points. So usually after the close, maybe 30 to 60 minutes, depending on where it is in the job, you'll get the new data point that's posted. That's why we don't calculate it intraday. I will tell you that some of the breadth data that we do calculate it today. An example would be the S&P stocks above their 50 and 200-day moving averages. We actually chart that, we actually calculate that value intraday. However, I will tell you, looking at any of this sort of breadth data on an intraday basis, doing like an hourly or a 5-minute chart, I would recommend against that. Because here's what you're actually doing. If you think about it, by waiting till the end of the day, you're getting rid of all that noise during the day and just looking at what happened through the course of the day and then getting a big update. Where are things at now? If you look at intraday data, a lot of things are moving at different times, and so breadth data can be a little bit misleading as you have a dynamic market, as you have trades coming from a lot of different places. The intraday breadth data can be a lot noisier, and I would argue a lot less useful. At the end of the day, you get one big print. There's the new value for the progression through the time of the day, and that's it. There are breadth indicators and market structure indicators that are more optimized for intraday data. I would encourage you to look at Richard Arms or Dick Arms Index. It's often called the ARMS Index. Some platforms call it the Tick Index. I think on our platform it's $Tick, T-I-C-K, if I remember right. But that is really meant to be looked at intraday. And I met Dick Arms before he passed away, unfortunately, a number of years ago, a couple times, and talked about using that as a measure of intraday breadth. So if that's what you're trying to accomplish, I would look at Dick Arms' work, which is actually maybe more optimized for what you are trying to do. Next question, how can I find out which equity has more potential to go higher? And I appreciate so much. You actually sent me the link to the chart that you were looking at, so I'll share it with you here now so you can see the question. And what you were doing is doing a stacked chart. And so those of you that aren't familiar with our platform or what all we're looking at, let me talk it through. This is the SPY 15-minute chart. So you can see the day count here, or the dates. And these are 15-minute candles that are printing above here. Sorry, so this is June 5th. This is, and then you can see the 15-minute prints for today's trading. Then this is Friday, and each the hours that are marked for the 15 minutes going through the course of the trading day. And then you have a series of stocks: Microsoft, NVIDIA, Meta, Alphabet, Amazon, and you're looking at all of them stacked together. And I think your comment was, how can I use this chart to figure out which of these is maybe in the best position to move higher? So that's a really interesting question. I would say you're onto something interesting, because here's what I would say. A couple things. Number one, I think using an indicator like Bollinger Bands could actually be pretty interesting, because what Bollinger Bands are trying to do is calculate where we're at relative to basically a range, right? And looking at a general measure of volatility, and that's how Bollinger Bands are calculated, looking at standard deviation bands around a moving average, and basically trying to identify when we're over or underextended, right? When something is at the lower end or the upper end of the range. So if your goal is to sort of track mean reversion with some of those names, that's not a bad idea. But I would say what I would probably want to do is use something more like RSI, the Relative Strength Index, which is something that this chart format in particular, I would say, is not super helpful, because you're trying to stack all of these stocks together. What I would suggest, and I didn't plan ahead a little bit, but indulge me for a moment. I would look at something like StockCharts ACP, and I don't have a perfect example of what I would probably look at, but I would say sample layout, something like, let's see, what I got of one of these, it's like 4 different stocks. Maybe this. Yeah, so this isn't a perfect example because this is showing you one thing. This is showing you the Dow on 4 different time frames. But if this is the chart of Meta, this is the chart of Apple, this is the chart of Amazon, this is the chart of Alphabet. So you can put the 4 different tickers, make them all the same charts, and make them all a 15-minute or 5-minute chart. Then you can use indicators for each one of these. And what you have to remember is ACP actually allows you to put quite a few of these. You could put 9 charts in here, a 3x3 grid with the SPY, and then a bunch of other 15-minute charts. And then you could use an indicator like RSI or something that's really more ideal for picking short-term peaks and valleys. If I was a day trader and I was looking at like a 5 to 15-minute time frame and looking for those swings, I think ACP is a much more dynamic, much more optimal time frame. Really, when we designed this newer platform on StockCharts, we had it with day traders and swing traders in mind, as opposed to more position traders and long-term investors, which SharpCharts is really maybe more ideal for. This is a more ideal, more dynamic charting platform. All the charts are going to update real time. You could stack a group of charts, and then you can zoom in and out of each one individually. That's what I would probably use for that. So I'd encourage you to look through the ACP platform, look through some of these sample layouts, or maybe even create your own. And I would do like a 2x2 or a 3x3 grid, and you can come up with some really cool ways of visualizing a group of different stocks on a short-term time frame and use different indicators to really understand their movements relative to one another in a dynamic fashion. That's where I would point you. And thanks so much for that question. Next one, what parameter was used to filter out signals on the McClellan Oscillator? We're back to my chart. This was a controversial chart, I guess. And I love this. What I love about this is just the simplicity of just thinking of color coding it based on green and red. And I will tell you, I've talked with our development team. At some point, I will spend some time creating an ACP plugin, which actually allows you to do some of these visualizations, because I have a number of ways that I like to visualize the data, particularly breadth data, and I think it's something that others could find useful. So it's on my list. It's on the Dave Keller list. Unfortunately, there are a number of things on there, but I will get to it at some point. But this chart I've shown a number of times recently, and what you were asking about is basically these little blips, right? I've shaded this whole area red, but you can see a couple times where we actually went above the 0 line. So if I'm staying true to this and saying, if it's above 0, make it green. If it's below 0, make it red. Why are you sort of, changing? What did you use to filter it? So I use a very simple, method, which is basically, I don't trust it if it's a 1-day break. I look for a second day. And if it does trigger the second day, then I will basically say it wasn't really broken, that it was, so it was a lack of follow through, right? And that goes back to some of the things we've talked about a number of times, particularly on support and resistance levels, right? You break through a level, do you follow through and continue on? A lot of times these are what you get in charting is more of a whipsaw, where you have an initial move, but it's not confirmed. You can see a number of times it's below 0, it breaks briefly above 0, and then goes right back. And so my color coding, which is a manual process at this point, was basically just ignoring those little 1-day blips. And for me, if you look at what's happened, it's a really good way of filtering out sort of those short-term whipsaw kind of moves that never really sustain the move in that direction. It's just a short-term reversal before the overall trend is continued. For me, this plays to what John Murphy and Tom DeMark and Larry Williams and Ralph Akinpour, many of my mentors taught me. All of them had some rule or some general way of looking for what I call follow through, which is don't trust an initial signal, wait for some sort of validation, whether that's waiting for a certain number of days or waiting for a certain percent threshold, or even just the next day keeps going, some way of validating that. And that's how I filtered out some of the noise on here. So anytime we broke, I always said, let's wait to see if there's follow through. And that is why I did it. Next question. What method would you recommend for determining projected price and time for a market peak? And I love the fact that we get a question like this. I will tell you right off the top, this is an incredibly difficult question to answer. I mean, you're basically asking, how can we predict where and when a top will occur? I would love to tell you I have that sort of holy grail indicator, and if I did, I would probably create a premium, some sort of platinum level service for you to have access to it. And I've seen lots of people try to do something like that, and nothing against any of them. I will tell you, nothing works all the time. There are a lot of things that work some of the time, and I would say with indicators like that, it's less about the indicator being so awesome. It's more about the indicator being pretty good, and you having a very good, disciplined way of analyzing and implementing the signals that indicator throws off. And that's what I would tell you as a general disclaimer, a general comment for something like this. There are a number of indicators that attempt to look for that cross-section, right? So if the S&P is rallying, right, how do I figure out where and when the S&P will top out? There are a series of indicators that we have on the StockCharts platform that are attempting to do that. I'll share with you some of those. If you go to the annotations engine, look under some of these different items, and there may be ones that you are a little less familiar with. Things like the ABCD pattern or a Gartley pattern that Leslie Juflas talked about on the show last week. I think that was on Thursday when we had her in the studio. Things like cycle lines, looking for a cyclical pattern, a Fibonacci time zone, which basically uses the Fibonacci relationship not for prices, but for times, right? X number of days, and you may have a turn. When you're looking for when a price is going to hit a top, you either have to use the previous data to project it, which is what tools like Elliott Wave or GAN or other sort of projection tools try to use, or you're looking for some cyclical pattern, and that's using like Fibonacci time projections or cycle lines. Larry Williams does a lot of that work. Jeff Hirsch from Stock Traders Almanac looks at some cyclicality using the seasonal calendar. So I would say you have to look at some combination of those two. If you're looking for a catch-all, how can I predict it? I would say that's what Elliott Wave from Ralph Elliott and WD Gann, anyone that focuses on those methodologies, that is what they're trying to do. They are not things I show often on the show because I have not found that they're a great part of my toolkit, because what I have found as a trend follower is if we hit some projection, but the trend is still going, I'm not going to care that we hit the projection. I'm going to want to follow the trend until the trend is no longer in place. So those are some things and some tools and some different disciplines that may help you answer that question a little better for yourself. We need to wrap the show, folks, so go to the 3 in 3. Let's talk about 3 charts in 3 minutes to tell the story of this market environment. Chart number 1, the McClellan Oscillator. We've talked about this chart a number of times, and I appreciate all the questions that we've gotten for it. I hope that you find this is a valuable way. Again, it is not a perfect mechanism by any stretch. And another way to answer the question we got earlier is it's imperfect, right? There are times when it just randomly goes above or below zero, and I don't consider those to be meaningful signals. It's a tough part about using a breadth indicator and trying to make it more of a systematic process. This is why I do more of a visual, more of a subjective analysis of indicators like this, because I find when you try to teach a computer how to look at these triggers, a lot of times it will consider these signals, and all of a sudden you get some really weird results, and it trades a lot more actively, and it's high turnover for no great reason. For me, this is a great, just simple visualization, and when I see the McClellan Oscillator spike above zero on Friday, I'm pretty encouraged by the fact that the breadth is improved to that point. I'm very curious what will happen at the end of the day today, because we had a bit of a retracement on a lot of those names that were working. The breadth was a lot weaker today. So I'll be looking to see if we get that one-day reversal right back below the zero level. Chart number 2, let's talk about gold. We've talked about this chart before. I hadn't talked about it since last week, and I just wanted to update where we're at. We've talked about this channel. Take a midpoint. This is actually looking at a regression analysis over this time frame to see where the trend has been, and I'm drawing some parallel lines above and below that regression channel. What's interesting is if you draw a parallel line or draw a trend line from the November 2022 low, line that up with the March 2023 low, you can see that lines up pretty much with where we've been over the last couple weeks on the GLD. Now, this is after coming down from the upper end of this channel in March and April and early May. So we're testing that lower end of the bands. On Friday, I was getting ready to sort of pen to paper saying, all right, this is now a breakdown. Let's see if we get follow through on Monday. We didn't. Today, we actually bounced back to the upside. The RSI is remaining above 40. This is still telling me we're in a bullish phase and we're at the lower end of the channel. I need to see a little further of a breakdown. And if so, GLD to 176 would be my general sense of the next step for that chart. Finally, AMD semiconductors certainly have been one of the stronger groups. You can see that AMD has rallied to a 61.8% retracement. I think that's important because that's the same retracement level for 4,300, 4,325 on the S&P 500. From there, we've pulled back out of the overbought region. Can we return higher and break above 125? That's the question for semiconductors and for AMD. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close. All of our previous episodes and interviews are at StockChartsTV.com. I'm Dave Keller. Have a good night.